Welcome to IB Acquisitions, your number one source of M&A information, where we teach you how to buy businesses, but most importantly, buying them without overpaying. Now, in today's video, I got Ansi, and we're going to be discussing our top 10 daily mergers and acquisition documents we use.
All right, let's go, guys. Let's go. You already know. Straight to the point. That's how we do it.
Okay, we're just going to give it a few minutes to get some people to come in. I'll just check the replay. Yeah, everything's good. All right, guys, so here we got various documents from templates, 2 legal documents, 2 financial models. We got a bonus document that we're going to be going over. Typically, a lot of people have not seen this one because it's going to be your last document, but it's definitely your most important one.
Yeah, absolutely, absolutely. And a lot of these guys, they've been doing this for a while, but they just haven't caught a lot of traction in the market. You know what I mean? So we're here to fill in the gaps and just provide you with the documents that you would need to start closing on 7-figure businesses. So without any further ado, let's get into it. And Valentino, let me know when you're able to see my documents.
Yeah, go for it. Yeah, got it on the screen.
Okay. So, guys, the first document that we want to talk about, and obviously we're going to be back and forth, Valentino and I, right, sharing our different perspectives on this. But to keep it short and simple, this is your executive summary. So, a lot of times you would start out with recruiting, right? So once you pick your industry, you know what industry to get into, where you're going to create the platform, what kind of platform it's going to be. You need a couple documents, and these documents that we're going to share with you is what we use in our business every day. And some of them we use more, and some of them we use a lot less. But once I go over these, it's going to make a lot more sense, right? So the first document we have starting out is our executive summary. And the purpose for this executive summary is basically to send it to the people that you're interested in working with, people that you're probably speaking to and say, hey, look, I would like for you to either join my board or be part of the deal team. And instead of you just telling them what you're trying to accomplish, you can simply send this executive summary, briefly highlighting what your plans are. So to start out, it has a introduction, very basic. As for myself and Valentino, we are in healthcare, and we're creating a self-sustained supply chain in healthcare. And in the center of that thesis is to buy a hospital, so a for-profit hospital. And in Florida, it's one of the states that allows private hospitals. Not all states allow that. So you have a very short introduction to tell the person who's reading this exactly what it is that you're trying to achieve, right, on the surface level. So with respect to what we're doing, it's creating a self-sustained supply chain in healthcare through acquisitions by becoming vertically integrated. Now, my investment thesis have changed up slightly. No, it's good. It's good. Don't worry about it. But my investment thesis have changed up slightly, and some of these aspects are no longer a interest to us. But for the most part, we are still looking at medical diagnostic labs in South Florida, primary care, and we've added not only family physician, but internal medicine as well. And our entire plan is to be self-sustained, and we want to rely internally on our own network. So that means we're not looking to outsource any particular part of our acquisition platform to third parties. That's not something that is going to make us self-sustained. And please chime in here, Valentino. But we have a lot of different components to this, some that are added, some that's been taken away. Pharmaceutical manufacturing is something that is a little bit more too complex, right? And we'll talk about the complexity of different industries in another video, but it's a little bit more complex than we'd like to deal with. So for that reason, we've decided to opt out of the pharmaceutical manufacturing. But just to get back to the point, the introduction is very short, straight to the point, and let the team know what it is that you're about. And then you want to have your mission statement. My mission statement is actually bridging the gap between patients and service care providers through vertical integration, right? And then you want to have your objective. For some of you, the objective will be slightly different. But what you really want to address is what the problem is in the market and what is your proposed solution. And then a financial summary. You guys have free reign to actually change this up once you get this document here. But for me, these are the main things that I want to highlight when I send this document to someone else, someone that I'm contemplating bringing on my board or working with in any capacity.
Let me chime in.
Valentino, you want to
So
add anything?
yeah, I don't know if you guys have seen a previous executive summary, but it was definitely 8 pages plus, up to 12 pages. The problem with documents that are very extensive is that nobody reads them. You want to have something that is short, sweet, and to a point. That really shows people that you're able to do your due diligence and your analysis, and you're able to capture what really matters. Again, you're one of many, so whenever you get to speak with these individuals, you want to make sure that time is used wisely to the best of your ability. Again, Nancy was able to capture what he's looking to do, which is build a self-sustained supply chain in healthcare. We saw this as an opportunity during COVID. If you were not in control of your supply chain, you got disrupted. Simple as that. And I could give you another simpler example, as in construction. Are you going to build a single service business model, or is it going to be multi-service? Right? Are you just buying HVAC and rolling that up? Or are you going to be the guy in California, Texas, whatever state you are, that offers all the services a client need? Again, referencing back to a key thing in business is people would rather purchase multiple services from one trusted provider than just buy one and figure out the rest.
Absolutely. And one thing that I would add, Valentino, is the point that you made, keeping the documents short and simple, right? Previously, again, we had a 7 to 8 page document. And when you're talking about bringing on people, right, you want to actually make it seamless as possible, right? You don't want it to be a hassle. So these guys, these high level professionals that you're going to bring on, they don't typically have time to read all of these documents, right? They want to be able to glance, and at a glance, they want to be able to understand what it is that you're trying to convey to them, right? So I just wanted to add to that point, Valentino. Let's move forward with the next document. And the next document, right? What we have is actually our business plan. You know what? Is this the? Do we want to show this one right now?
We can't. Let's give them a glance. Because this is one thing I've seen a lot of the gurus in M&A or a lot of individuals say you don't need a business plan. It makes no sense. But once you're looking to get capital, you're looking to get funding, they're going to want to see a business plan. They might not read it all, but they're going to want to see that business plan. Expand on that,
Absolutely.
Nancy.
Absolutely. So I'll just briefly touch over this, right? When you're talking about, well, if you're going to do 100% investor route, a business plan is a little bit less necessary. Investors really care more so about the tangibles. What I mean by tangible is things they could actually see, right? So kind of like your pitch deck and kind of like your capitalization table, which I'll go over in a few minutes. And they actually want to speak with you and feel you out as a person. But this is strictly on the investment side, well, investor side. But if you're talking about utilizing the SBA, you are 100% going to need a business plan. And not to say that the banker or the underwriter will actually read all 30, 40, 50, whatever page you have in your business plan. It's just to show that you know what you're doing and you have your ducks in a row. So
Let me add to this.
Go ahead.
I want to make this point. It seems like a lot of people are technically doing things just for the sole purpose of getting the deal done or getting the financing. You got to understand, this is your company and you're going to assume 100% of the risk of it. Why not invest the time and do the actual market research to figure out what's going to be your plan? If not, you're just going to end up like those individuals that buy one business, maybe two, unsuccessfully merge, and then you end up running both. You do not want to be in that position. If you want to be a fund, you got to operate like one. It'd be ridiculous to assume these big funds like BlackRock do not do their market due diligence. Operate as one. And see, scroll down and show them the business forecast, because this is something I don't see a lot of people doing at all.
Absolutely.
So this is a forecast Ansi and I came up with for the business based on the two deals we currently have and the future expected deals we're looking to do. So if you're able to see here, we are looking at a 15% growth rate that we know we can grow these businesses at on a yearly basis. On top of that, we're going to be growing these businesses at a 3% over that 15 continuously. You can see here, these are the total revenues for 2024 projected. 1.1 is coming from current businesses. There's going to be the acquisitions, and then 5 million additional from future businesses. So you gotta picture out, hey, how many acquisitions I'm gonna do? What is gonna be the size of these? What's gonna be the time frame? How many I can realistically close in a year? That's gonna be your revenue forecast. And then we break it down from cost of sales, EBITDA, so on and so forth. Scroll down to the bottom a little.
And 1 second, I might add here, when you're looking at total revenues, right? These are from the acquisitions that you're going to make. So a lot of you may be wondering, well, if I'm essentially a umbrella company that's going to be buying these other smaller companies, or just buying subsidiaries, what's our revenue, right? So when you're talking about acquiring businesses, and if you don't have a product, which a investment firm, you don't typically have a product that you're offering. So the acquisitions that you make are going to be these things are what makes up your revenue as a investment firm. So I just wanted to touch on that. When you're looking at this 6 million, 13 million, 23 million, you might be saying, okay, well, that's kind of, a little bit of optimistic when you're looking at these growth rates. And in fact, we were slightly on the conservative side when you're talking about these growth rates. The acquisitions that we plan on making is actually going to exceed these numbers, but you still want to be conservative. And, albeit some bankers, underwriters, they might say, well, I hear that all the time, conservative, but these numbers don't really check out. But that being said, you have to keep in mind that these numbers here are directly correlated to the acquisitions that are being made by your firm. So just keep that in mind.
Yeah, let me add to this. One great way to start your forecast is just look at the deals you currently have under contract. That's a great way to base your forecast. And then you can model out how many more. I mean, one great example we see all the time is look at tech companies, tech startups. How do you come up with $1 billion valuation pre-revenue, right? Basically this. You forecast the future value of the business. Now, if you're able to see below, we got and I don't want to spend too much time, but here we got our preferred return for our investors. And then I want to make this point very importantly, the subsidiary stake. This is very important. A lot of people are giving out equity to a point you only got 40%. As he can show you, he's going to retain 85% of his company. That's his subsidiary stake.
And let me just touch on that real quick. So this 85% here is actually with a dilution. I've already had dilution that occurred. I have one investor. I've touched on this in previous videos, but this is with dilution that has occurred. So right now, it's more closer to 83%. Now, at the end of everything, it's gonna be about 42 to 45% subsidiary stake. So just keep that in mind, guys. This is going to be this stake here is going to change, and it's gonna actually decrease over time. But there's one way to actually keep that a little bit more afloat than sinking, and one way is to utilize commercial debt or bank debt, which is exactly what I'm doing for these two acquisitions that we're closing in less than 90 days. So keep that in mind. Your first acquisition, you're going to need to bring on a partner. You're going to need the investors. But after that first acquisition, your second, third, fourth, and so on, you're going to be less dependent on that investor. So always keep that in mind, guys. Valentino, let's continue.
Yeah. All right, pull up the next document. Then we're going for a seller brochure, aren't we?
Okay, yeah. So we have our seller brochure. We've actually showed our previous seller brochure, but this one is a little bit more updated. All of our documents, by the way, has been updated. So we don't like to keep using the same, the same things, the same documents, the same script
Typically, every
year
six
after
months
year
we
after
we
year.
upgrade them.
Right. And typically some of them, we update a little bit, quicker than that, depending on what we're doing right now, what our team is doing, and exactly what kind of moves we're trying to make at that time. But this seller brochure here is what you sell, what you send to the sellers. A lot of times people would engage sellers and say, hey, look, are you interested in buying your company? So what happens when the seller says yes? Typically, you would just move forward and say, well, let me request financials from you. And a lot of newbies, a lot of people who are starting out buying businesses, they have, that's almost, I would say that's probably the number three issue they have, getting financials from sellers. Number one is actually finding off market deals. Number two is raising the capital for it. And the number three is actually getting proper financials from the seller in a timely manner. We've seen anywhere from 1 month to 3 months with respect to getting a NDA from a seller. That is completely unacceptable. But that being said, perception is reality, right? Well, it's greater than reality. Why do I say that? Is because a lot of guys, they engage the seller. What else are you doing to put in that seller's mind that you are actually a functioning corporation, right? That you're trying to succeed on purpose. Well, one thing that we do once we engage seller, we actually send them our seller brochure. Now, I'm going to just briefly go over this document, not in its entirety, just to give you an idea of what's inside these documents and why we have so much success rate when it comes to dealing with these sellers and building rapport.
Very
So this
quickly,
seller brochure
um,
breaks down. Oh, go
yeah,
ahead, Valentino.
very quickly, I want to touch on how we came up with this.
Yes,
As
sir.
you know, we love to optimize everything. So if we see something taking a week, hey, how can we bring it down to 3 days? But one issue we saw that was repetitive is that whenever we're doing these strategy calls, these introductory calls with these sellers, we're over here basically presenting so much information to a point they get overwhelmed, right? So instead, this is what we do now. We send a seller brochure initially after a first call, and then they receive that. They take a look at it. They understand our system. And now when we get on the phone with them on our first call, we're not talking about what we do. We're talking about how can we structure this deal and what you're looking to get out of it.
Yeah, and it's just a little bit more easier, right? It's just a little bit more seamless. And as a beginner in this game, one of the things that you should strive for is not only having a system, right? A repeatable system, but you also want to make sure that you have your processes. And some of the processes is actually going to help you just get things moving along a lot quicker and a lot easier. So like Valentino said, once we send this here, we're not discussing our process and all of these things. No, it's basically, hey, we're active in the market. This is who we are. Now, let's just go beyond talking about why you're looking to sell, but let's just talk about a little bit more about the business and where you are right now and what it is that we can do for you if we're a right fit to buy your company, right? So again, you're cutting out a lot of fat, and that should be your target. You need to cut out as much fat as possible because that's what's going to get you closer to that finish line a lot quicker. But just to go over this, right, it describes our approach, how we work with business owners. And then it's a us versus them mentality, which is what you should have in business always, right? And then we talk about buy and take over and then buy and build. So one thing that I do want to do, Valentino, is actually update this a little one last time to add a self-sustained supply chain, right? And why that is something that is that's something that some of these owners may be interested in because these owners they're not usually savvy on the business management side or the growth side of the business.
Let me
So
add to this. I
go
saw
ahead.
the value in this in regards to self-sustained supply chain. I think it's like an underlying value. But essentially, a lot of these business owners you typically see, you might see them in their early 40s, mid 40s, early 50s. Well, they still got about 10 to 20 years before they retire. How do you deal with businesses where the owner wants to eventually sell, doesn't want to sell right now? Well, have them be a part of your network, right? If you could do a joint venture with them, you buy into their equity. Now they're a part of your self-sustained supply chain. The day they look to retire, they don't have to worry about a succession plan. It's going to be a seamless transition where we will take them out, replace them, but business has been operating and will continue to operate as usual because they're already a part of our network. And I think that's a very good value point as opposed to, hey, let me just take over, goodbye, and figure out what you want to do with your life, which is typically what happens. In this case, NC has a deal where one of the individuals wants to stay on for a few more years. Hey, there's a great play for them.
Absolutely. So let's get into the next document, guys. So this one here, I've covered this in a previous video, but this is basically my investment thesis visualized. I haven't seen anybody that's done this here, but it's basically really common sense, right? What I wanted to do is, aside from telling people exactly what our plans are, the timeline that we have, it just made a lot more sense to be able to present that in a visual way. So just allow me to spend about 30 seconds to just go over this, right? At the very top is our, basically the company's management, if you will, right? The executive branch. So we have our CEO oversight, CFO oversight, and COO for operations and management. And then we have our sales team. A lot of people don't talk about this, but how are you going to exit in 5 years, which is typically the time frame these search funders or independent sponsors have? How are you going to be able to pull that multiple acquisitions off in 5 years without having a proper sales team? And then if we go just a little bit over to the right some more, you would see that we have a management team, which is very different than your executive team, right? And then now if we go down here, you can see exactly, well, I'm going to tell you exactly where I am right now. I am actually kind of in the middle here. So the first year, our primary focus is primary care and internal medicine practices. And then we have our secondary focus, which those are medical staffing and home health. In fact, we're closing on a medical staffing deal, like I said, in about 90 days, less than 90 days. So the primary care actually is something that we've not had much luck on acquiring, but we do have a family practice, right, which is part of the our primary focus. But we actually have something that is the secondary focus, which is the medical staffing we're closing on. But if you look up here, right, I just basically have everything that's connected to what facet. So if you look durable medical equipment, this is something that we're getting into because for us to be truly self-sustained, we have to have our own equipment. And as you know, medical practices, whether it's hospital, standalone, home health, a lot of these have medical equipment that they utilize. It's a must. That being said, it just makes sense for us to control that. When it comes to billing, a lot of physicians do not handle their own billing in-house. And it's about 5% that you would pay for the total amount that's billed. So if you bill $5 million for that year, the company who's doing your billing, they keep 5% of that. I'm not really interested in having that percentage, leave the company for no good reason. In fact, we have people who has been one of my business partners. She actually has extensive experience in medical billing and coding. So, and also office management, right? So that makes sense for us to be able to just control and have in-house. And that 5%, it's going to add up when you're talking about owning 30, 40, 50 medical practices and business, related businesses.
Let
So
me
we're
let
going to
me
keep
add
that
to this.
in-house. hmm
This is, I know we talk about self-sustained supply chains. There's something new, but I feel like people really haven't wrapped their minds around how it actually works. This is a
Right.
perfect representation of how it works. Now, you're going to tell me you're doing a roll-up, and then I'm going to tell you I'm doing this. What do you think who's going to get the funding? What's your mind map going to look like? 10 of the same? You see what I'm saying? It's about strategic placement in the corporate
Exactly.
world. Again, everybody talks about, hey, how can I become recession proof? That doesn't exist. How can I become recession resistant at least? Well, for one, don't put all your eggs in the same basket. That's really what a roll up is. In this scenario, regardless to what sector gets affected, we're still operating. We can take a loss and continue operations. This not only makes our business model that much more profitable, but it does the same thing everybody wants to do: minimize the risk for investors, which is the most important part. Investors putting all their money in the same eggs, it's not going to be efficient for them. Instead, when we're pitching to investors, it's like, hey, this is our model. This is how involved we are. This is how much we can expand. But most importantly, this how much we control. They're able to really see the vision, and they're like, wow, if anything was to happen, it's really not a liability for me because eventually it's gonna stabilize. But for the most part, we'll be able to continue operations.
Absolutely. And again, just looking at this here, you can see the legwork that's involved in actually pulling this off, right? This isn't something that is going to. A lot of people have the, uh, an idea that hey, we're going to buy these businesses, just look for businesses and let's just buy them. That's great and all, but what about the integration, post closing integration? So if you see here, with everything that we have going on, our a full systems integration is not happening until the fourth year, right? And then if you look at phase four, like I mentioned previously, at the center of my investment thesis is a hospital acquisition, for profit hospital acquisition. So we are not going to be there until the 4.5 year mark, right? And if you look at the post closing integration I have here, it's going to be something that's CapEx heavy. You're going to be spending a lot of money to fully integrate everything, right? But if you look at the full systems integration at year four, this is what's involved, right? So the management team, it has to fully integrate everything. And then we are preparing for the hospital acquisition. And then if you look at the closing, post-closing integration, that leads to a entire network integration, right? So we have a full systems integration, and then later we have a network, entire network integration. And then lastly, which is, so this is year five. This is year six, and this is our exit horizon. This is a 7 year investment strategy here. And we could have done it in five, but it was going to be a little bit too tight. And my team and I we just was not comfortable with that. So this is something that is not going to happen, tomorrow, next year, next 2, 3, 4 years. This is going to happen in 7 years. But I am looking to exit, you know, near that $1 billion mark. And really, what's going to allow me to exit at $1 billion mark? When I say exit, we're not going public, by the way, right? I had this here, but we're not really entertaining going public anymore for specific reasons I'll talk about in another video. But we're looking for a 15 minimum valuation multiple with our entire portfolio. And I'm also looking to exit the entire portfolio at once. I've had some of my team members who say, hey, maybe we should get rid of, different parts at different time. I kind of disagree with that. I want to exit entirely, and that's going to be a private sale. So just keep that in
Yeah,
mind.
we're gonna
There's a
bundle it up
lot
and
of
sell.
that's associated with this to really pull everything off. And honestly, what's going to be the most difficult part is actually the entire network integration. You can do 3, 4, 5 acquisitions in 1 month, but you may not be able to fully integrate everything if you don't have the right people. Go ahead, Valentino.
Let me add to it. I see a lot of people throwing out multiples. Yeah, you go public, get 10, 20 times. That's not how it works. You know how many companies have failed at IPO? How many companies have underperformed at IPO? You don't want to be one of those. So a lot of people are talking about just rolling things up, putting it together. Let me throw a stat out. See if this gives you a little confidence booster. The failure rate on an acquisition is up to 30%. The failure rate on a merger is up to 70%. So you're telling me you're going to acquire 10 companies and successfully merge every single one of them if they're all the same? It's not how it works. Number one reason why a lot of mergers fail, culture clash. If you got 10 of the same, they're all operating differently. How can you get 10 companies with 10 methods of operation to agree on one? It's going to be a disaster. The way we're set up is we have a central business, which is the hospital, and then we got all these other companies that make up the ecosystem and they supply each other. They're not competing against each other. They're not disrupting each other. They're all coexisting in an environment, which makes the merger that much more smoother.
Absolutely. So look, let's go on to the next one, which is our one pager, right? So the one pager is what you will need to actually advertise your deal to investors. A lot of times when well, it's hard to get investors on the line. That's one. It's not just going to happen. It's not happening just because you say, hey, look, I have a deal. You have to have proper investor presentation. And there are a few documents that are involved in that investor presentation. But a one pager is what you send out that is literally one page, right? Remember, we do not want to have too much for these guys to read. So it's literally one page that basically highlights your company, the deal, the capital raise that you're looking for, part of your team, expected use of funds, revenue projection, the business model, the market opportunity, marketing strategy, value proposition that that's in the market from the deal that you're looking at, and then some market research factoids, some competitions, right? You want to list that, and then lastly, you just want to finish off, a little bit more about your company philosophy, mission statement, vision, and that sort of stuff. But you want to have a one liner, right? Because these investors, when they've never dealt with you before, so you need a one liner to basically tell investors what it is that you're bringing to them. And in our case, right, we give investors a 15% return, and we minimize losses through healthcare acquisitions in South Florida, and we 3x investments at exit. So this one liner here tells them everything they need to know about us, from that one line. Valentino, let me know if you want to add anything to this, but this is very straightforward. This is the document that you use just to get these investors to say, you know what, I'm interested in finding out a little bit more. Let's have a conversation. So typically when you deal with investors, they'll give you 5 minutes. If they're interested, okay, now you get like 15 minutes, and then you get a much more lengthier call, about 30 minutes or so. Rarely do you ever speak to an investor for about an hour. If you're on the phone with an investor for about an hour, it's a little bit further along than just kind of pitching to them the deal. They're interested. They're probably going to give you some kind of capital commitment, but they want to know a little bit about you more personally, and then overall the deal, your investment thesis, and everything like that. But it's typically a 5 minute, 15 minutes, and then you have 30 minutes with these guys. And this one pager is what you're going to send to get them interested, right? To get them
Right.
interested to speak with you.
Let me add to this. I think this is a great test, as in, is your business or is the acquisition you're looking to make worth the acquisition? Meaning, for you to get to a point where you're going to put a one pager, you've done a lot of the work. You've spoken with them, you negotiated with them, you valued it, you've done some level of due diligence. So if you're able to get to a one pager for your deal, you got something you can present to investors. Again, it's 100 deals you go through to find that one, right? So when you're putting that one pager, you have something you could work with. But then again, this shows the level of effort. Are you running your business like a business, or are you just throwing deals and hoping one lands?
Absolutely. Absolutely. So the next thing I want to get into, we're kind of going in order here, but the next document I want to get into is something that I've gone over in a couple videos, but it's what I use, yeah, almost daily
Very
in my.
quickly, we got to do the LOI before we
This
hop
is,
on.
yes, the
Okay.
next one. So this is my LOI, and I have not seen a more extensive LOI than this. Obviously, when you're talking about a 50 $100 million acquisition, it's going to be a little bit more lengthy. But the reason why my LOI is so extensive is because it covers certain things that you want to get out of the way right now. So once you get to the purchase and sell agreement, PSA or APA, however you want to word that. Once you get there, you're not really trying to figure out, hey, reps and warranties, right? Indebtedness, all of these things, malpractice, non-compete, consulting agreement. These are the things that I addressed in my letter of intent. So that way, after I submit this and it's fully executed by both parties, which is myself as the buyer and the seller, once that's fully executed, they have 72 hours to send me everything pertaining to due diligence. And when I mean everything, it's a list that myself I send to the seller, requesting certain documents, which are financial and legal documents. I'm talking about from tax returns all the way down to employment agreements, right? So we request all of these documents. They have 72 hours to send it to us, and then we get work. But like I said, this is a little bit more extensive than some of the LOIs that you're used to seeing, and it's for a specific reason. And everything that I do is to actually minimize the time wasted.
Let me add to
Because
it.
when you're talking about closing acquisitions, that closing date will come up quicker than you think, especially if you need to raise capital, whether it's investor or debt. These things take a little bit of time. So you want to give yourself, ample room to be able to maneuver if you need to maybe extend the LOI, or if something else, some unforeseen circumstance happens, right? You're able to, have time to just get things right. But it addresses a lot of things. For example, I do not use brokers whatsoever, and that is just something that I myself is not interested in, right? But it has everything, all of the governing laws, and then we finish it out with the execution of the both parties, the seller and the buyer, which would be you. In this case, it's me. So I just wanted to touch on this, briefly. Any points, Valentino?
Yeah, absolutely. I feel like a lot of people are scared when it comes to legal documents. Again, we're in business, the highest tier of it, and you want to treat it as such. Put yourself in the position as if you were to get sued. I know LOIs are legally non-binding, but if you were to get sued, is your LOI comprehensive enough for you to stand a chance? Or is it so bare bones and minimal to where a lawyer could get you at any angle? I see like a lot of people are scared to actually negotiate and set their terms. This is mergers and acquisitions, the highest tier. Let me say that again, the highest tier. And you want to ensure whenever you're conducting business, you do it appropriately. As you can see, ANSI document covers everything. Your LOI should be a reflection of your PSA. You don't want to have a few items and then you get to your PSA and it's like 30 pages and they're like, well, we didn't discuss this. That's how you break a deal. You want to cover as much ground as possible upfront. So when you get to an LOI, it's nothing more but an expansion upon the points you previously made, not an addition. So keep that in mind
Great
whenever
point.
you have your documents.
And lastly, what I want to add, when they're not just with respect to the LOI, but any document that you send out to a seller. Now, according to my attorney, the seller should not be able to just view the document that you send them and say, "Hey, I've read over it. It seems pretty straightforward." That's a bad sign, right? That's a red flag. And I'm talking about as a buyer for you, that's a red flag, right? You're personally, from my attorney, right? Just off record, he's like, the reason, well, you want to control the documents. One, you control the document, you control the narrative, and you control the deal. Never let the seller send you their document for you to execute, right? You should be sending the seller your documents for them to execute. The reason why is because once I send this here, it is the best I'm going to get. Meaning, I'm going to send them everything that I myself would want to have in that deal. And it is the seller's job to actually counter and say, well, I'm not going to agree to this. I'm not going to agree to that. Well, can we do this? Can we do that? Right? So the first document you send out is going to be the best case scenario for you as a buyer. And conversely, the seller, that is going to be the best case scenario for them, because once we start going back and forth and we start negotiating, it's all downhill from there, right? It's not going to be everything that I want in the document, and it's not going to be everything that the seller wants, right? So just keep that in mind. You don't want to send a document that's just bare bones where the seller's like, oh, wow, this is very straightforward. No, you want the seller to say, oh my God, I can't look at this myself. I need my attorney. And another note, you don't ever do a deal with the seller not having proper legal counsel or representation. Reason why is because after the deal is closed, they can actually come back and sue you, and the judge would actually favor with the seller. And the reason why is because the judge would say, well, business acquisition, buying and selling business is something that is extremely complex. Because it's so complex, the seller, you should have advised that the seller, get legal counsel. And because you did not do so, that deal could actually reverse. And unfortunately, you will not be the party who wins. And the seller would keep what you gave them, including whatever other commitments you may have to that seller you may be liable for. So just keep that in mind. Now, let's go on to the
No,
next
I got a
document.
side note for this because it is very important what you just stated. Just as with the seller, you want proper legal counsel, you yourself, you want proper legal counsel. I feel like a lot of people forget that these legal documents are written in its own language, which is legalese, and certain words can really change the entire perspective of the document. I had a case where an individual was signing a document from a broker, which is something you never want to do. But they were asking escrow. Yeah, escrow's common, cool, whatever. The point is, in the document, there was a word that could have changed the entire scenario, which is that escrow was non-refundable. So you want to be careful with these documents. Have your attorney take a look at it. One word can change the meaning of everything.
Yeah, absolutely. Absolutely. Great point. Great point. Okay, so let's move on to the memorandum of understanding, right? I probably should have showed you guys this before the letter of intent, But this document specifically is what you send your team. So when it comes to recruiting, it's great. Yeah, let's say you have 4 or 5 people. You have your team that says, "Hey, guy, yes, I will work with you. I'm interested in working with you." But they're not just going to take your word for it alone, right? That's extremely unprofessional. But what is the document that you send these guys before you have your filed entity? Because commonly, a lot of the people who are starting to, buy businesses, they're not just going to have a filed entity. They're not going to have a LLC or a corporation, right? So because of that, you actually want to send them this document here, which is a memorandum of understanding. Now, this is non-binding, by the way. This is not a legally binding document, but it actually outlines what your responsibilities are and what you're expecting from that candidate that you just brought on. And this is actually you're just putting, the pen to paper when it comes to bringing these people on. So you wanna be careful of what you send or what you say, because it has to be reflected in this document here. So let me just go over this, about 30 seconds. Parties that are involved, that's me. I did not sign this in my personal capacity. But if you choose to do so, it's not an issue, because this is non-binding, by the way, right? But I have my LLC here as the representative party. And then it states my background, which it would state your background. I'm an entrepreneur looking to monetize my knowledge, contracts in the medical community, so on and so forth, right? And this here would be the physician. Well, in my case, this was it's for a physician. But you would send it to the individual. It would be the individual here with whatever experience they have and what you guys are looking to accomplish. Purpose and scope. This is very straightforward here, what you're looking to establish. And then you have terms, termination. Again, this is not legally binding, so you don't have to worry about anything. My responsibilities, which would be your responsibilities, is for me to work diligently to provide a legally binding operating agreement, which is from my company, right? So this is what you want to send to these guys. And then here is the responsibilities of the individual you're bringing on. Like I said, this is for a physician, right? Medical director or medical advisor. But you would have to actually change this up with respect to the person's background that you're talking about. If you're talking about a M&A director, then it's going to be for M&A purposes. But you want to leave out the medical or the whatever your industry part is. You want to leave that out. But this is going to be pertaining to whatever that person's background is. And then general provisions, right? Just legal jargon here. Binding effect, like I mentioned, this is a non-binding here. This is basically in good faith saying, hey, look, I'm going to bring you on, I'm going to pay you this amount, that amount, but let's just put something on paper and this is what this is. And then lastly, you have the signatures, right? So this is the document that you send to your candidates after they said, yes, I am willing to work with you, or yes, I'm interested. I want to join your team. Let's finalize it. So this is the document that you would send to these guys after they come on board. Any points you want to add, Valentino?
You're gonna solidifies really the relationship with the individual, because a lot of these guys is, first of all, you don't have a form entity. There's really no documents you're giving them, so it's just all over the place. I'll reach out to you whenever. This forms more of a contract where it's like, hey, this is what I'm doing, this is what you're doing, and this is what we're gonna do. Again, now they're a part of the business, so to speak.
Absolutely. So now, the final document, I'm sorry, number 8, right? Number 8 document, or number 7, I'm sorry, number 7 document. The number 7 document is, I don't use this kind of daily like that, but this is for those who are looking to have deal flow, right? We don't deal with on market deals, but one of the strategies that we use is we have a fee agreement where we work with either M&A firms or investment banking firms to have them send us deals. And the deals that they send us, we pay them a 3% fee. So this is what this document is. This is an agreement, that outlines me as the buyer and the finder's fee, what the percentage is, right? That I am not paying anything for that deal that I'm working on. In the event that the deal does not close, I, I do not owe anyone anything, right? So that means if I'm working on a deal for 3, 4 months and there's some, disagreement between me as the buyer and the seller, we just cannot come to, we just can't meet in the middle. Well, I can easily just terminate. But what's going to happen is I am not going to owe the investment banking firm anything in this outline. It is outlined in this document here, right? And then there are some other provisions Kind of like if the deal closes, but it's not the amount that they close for, there's some kind of adjustment in that. But this is just what this is, a finder's fee to be able to help me find more off-market deals. But this is for to deal with, either PE firms, which you probably won't deal with, but PE firm, M&A firms, and investment banking firms. That's what this is. But remember, you're paying a 3% fee. But if you're talking about, doing deals that you otherwise would not do, 3%, it's not really that much. Anything you want to add to this, Valentino?
No, you pretty much covered it. It's great.
Okay, great. So let's move. Let's move on to the financial. Well, let's move on to the cap table, capitalization table. I have two of them pulled up here, but I'm just gonna go over this one here. Now, a capitalization table, cap table for short, is basically what investors will want to see because a cap table lets them know exactly who are all of the owners, what investors you have, if any, and what board members you have, but what equity have you distributed amongst these other people, right? Let me look at this one. So when I started out, I had 12 board members. I no longer have that. There's only 3 board members: myself, my business partner, and my investor. And then my deal team. That's different. But what the investors are going to want to know is who are the people that are involved, whether it's advisors, team members, and who have a certain amount of equity and how much equity they have. Now, this is fairly old. I no longer use this, but if you could see here, it has before you get diluted and after your dilution occurs. Like I said before, I have about 83, closer to 83%, which you could see here, but this is not a real representation the of my shares right now. I actually have 100 million shares in my company. So this is a little bit off, right? But this cap table is basically to show how much shares do you have in your company? What is your pre-money valuation? What is the equity you're looking to raise? In this case, this is 500,000, right? And shares outstanding. But it's going to give you your pre-money valuation and your post-money valuation. But investors want to see this because they want to know, hey, if I give you 3 million and let's say you give me 20%, how much dilution is going to occur? But also, the most important part, you're going to need to raise more capital. In the event that you need to raise more capital, let's say you do a Series A, Series B, how much equity are you giving out for how much capital? And how much dilution is going to occur. Now, obviously, investors, they will want preferred stock, right? They don't want just basic stock. So, and there's other ways that you can kind of structure to where you don't lose as much equity. There's a couple different ways. I'm not going to get into it here, but there's some very, very interesting ways to kind of save yourself from dilution, which it's kind of inevitable, right? But this is something that the investors are 100% going to ask you for because they want to know how much equity they're going to have in your company, how much dilution is going to occur, and who else has equity in the company and why, right? So, guys, I know a lot of you may say, hey, I'm giving my board members equity. I'm giving this guy equity, that guy equity. And the investor is going to ask you, you're giving this guy equity. How much capital have they contributed to the company, right? So I'm sorry to say, guys, but whatever equity you give to your team, it really doesn't matter once the investor come on your first your $1 investor. Once he comes on, he's going to say, who has equity? Why? How much has they contributed? It's basically they're going to laugh and say, well, they don't have equity, right? Long story short. So this capitalization table is very, very important. And I would actually, if I were you guys, this is something I would be playing with extensively, just so you know exactly what different scenarios would look like. And ultimately, when you exit your company, what are you exiting with? How much dilution is occurring? And how much are the investors getting? And is it going to
Again,
make sense to give you the capital that you're asking for?
right. This also shows how much equity you think you have and how much equity you truly have after taking into account that dilution.
Absolutely. 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 So now the next document I want to go over is the valuation model, right? So,
So in this valuation model, Nancy and I crafted this, and it's very extensive. I mean, we've gone through many, but ultimately, this is specifically based for SMEs, which are the type of businesses we're going for. Show the first page, the questionnaire.
yep, wrong mouse.
So whenever you're analyzing a business, you're gonna come up with questions, right? Here we break it down by sections: the P&L, balance sheet, forecast, cash flow generation. You got your why, your how, when, and what. This is going to be very important for the due diligence part because, again, numbers talk to you. Numbers tell a story. So when you start looking at these numbers and you see abnormalities and anomalies, you want to write them down. Instead of going to a separate notepad, just include it in your model and just keep it right with you. Can move on to a summary. I'm just going to show you guys a summary and the charts. We could leave the rest for another video. Summary is going to be very important. Now, I used to fiddle around with a lot of pages. I would go back and forth, and it would just confuse people. Instead, I created the summary page where essentially it outlines everything. If you scroll up and see, the first thing is going to be your deal structuring. Here you can see the sources. You got bank financing, seller financing, earnouts, equity hold, investor, equity injection. Right, was the interest rate, the percentage, the length, the annual principal, interest, the EBITDA multiple, free cash flow multiple, return on invested cash flow, the amount, and then the totals for all of them. It makes it very easy for you to understand how this deal is getting financed, how it's getting structured, and how much. If you see on the right side, go up real quick, it's going to be your closing fees. It's very important because you got to count that. That's a part of your cost of acquisition. You got to include the closing fees because somebody has to pay for it. So here you're going to have your total closing fees. Below, you're going to see your key metrics. Again, these are very important metrics that basically detailed on the left details the performance and health of the company and then the average of all 3 years. On the right, you can see your cash flow statements for 22 and 23 and then your tax rates. And lastly, at the bottom, you're able to see basically a P&L analysis for 2019 to 2020. 2019, 2020, 2021, and then you come up with your forecast for 2023 based on averages. Basically, this is your summary, and then lastly, move to the charts because this is very important. I realized this. I really didn't used to use charts before, but once we started playing with charts, me and Ansi, we realized that numbers, they might seem linear on paper, but once you actually visualize it, you can see the regularities in it, right? So if you see the EBITDA forecast, previously EBITDA looks like it was in an upward trend, but the forecast is showing a downward trend. Why is that? Right? Same with the free cash flow. Free cash flow here seems like it skyrocketed, matter of fact, but in the forecast, it seems like it's going to go in a downward trend.
Well, real quick, guys. So, you want to be careful with this hockey stick here. Banks, especially investors, they hate hockey stick projections, right? So when you're looking at your financials and everything else, you want to make sure. Now, obviously, this is kind of a hockey stick, but it's an important metric. This is your free cash flow to firm, right? But when you look at your financial projections overall, it should not be a hockey stick. Now, there will be certain circumstances where it's a hockey stick. For example, if you're looking at a company, it's owned by a seller that's ready to retire, but there are a lot of potential that's locked up into that company, right? It's going to be very unavoidable that you have a hockey stick, right? It's going to be very, very hard because any little improvement that you do in that business is going to raise, it's just going to have a upward trajectory with respect to the revenues and obviously your bottom line. But you want to make sure that overall you're not looking at a hockey stick that's that's coming from the floor and is going to the moon, right? You're going to have to explain that in great detail when you're talking to these bankers and investors because that's just something that they do not want to see. And if you have that hockey stick, you want to make sure that really, really well the business that you're looking to buy. It should sound like that you've worked in that company for years, how much you know about it, because that's going to be the only thing that make investors a little bit more comfortable with that projection that you're putting out there. And when it comes to projections, garbage in, garbage out, right? So it's what you're putting in there. And all of our projections, when I say we're conservative, it's a understatement.
No, let me explain something because people do not know how to do projections. When you do a projection, you got to take into account the seasonality of cash flow. You cannot assume a linear projection on a monthly basis. That's why our projections, we don't do them yearly anymore. We do them monthly, and we account for dips, losses, and months with no income. That's how you get a proper projection done. Instead of assuming linearly, yeah, you're making $1 million a year, cool. But if you're assuming you're making whatever amount every month consistently for those 12 months, you're going to have problems paying your debt. because January you might be able to pay it off, February might be good, March you're negative 15,000. The month after you're negative 20,000. Now I carry the previously 15, now you're negative 35, and then it just becomes a mess. So you want to understand how stable your cash flows are on a monthly basis. That's how you get your projections done right. Here you can see on the charts.
No, go ahead, finish.
Yeah, what I was going to say is here, as you can see in the charts, we leave no metric out. You got your net income, you got your cash flows. If you scroll down, you got your free cash flows, you got your receivables, you got your payables, you got your assets to liabilities, you got your cash ratios. Here, the financial structure, you're able to visualize the company. You know, what's the gross revenue, what's the COGS, what's the gross profit, depreciation, amortization. You can see here from net income to gross revenue, a huge change for every year. So these three, your questionnaire, summary, and charge, basically going to complete your analysis.
So one thing I want to add when it comes to the hockey stick projection, another reason why banks, investors don't want to see it is because it's like, well, okay, if you're utilizing debt, how are you on a upward trend that much if you're paying down debt, right? So a lot of times, the same thing as the hockey stick projection. When you see a downward spiral, that's not a bad thing. Reason why is because you have debt. You're taking on debt, and you have to pay that debt off. So the first year, second year, third year, fourth year, fifth year, however, whatever amortization you have on that loan, it's gonna decrease. But then you should expect for it to start picking up as the loans get paid down a little bit more. You're going to have a little bit more free cash flow available, and then that's going to start to go on that upward spiral. So just keep that in mind. Just because you see a decrease in the free cash flow, right, that doesn't mean that the business is failing. That's actually that's the trajectory that you really want to see when you're talking about buying businesses, especially when you're utilizing loans. But if you're gonna do something like I did, 100% investor, then it may be a little different, right? Because we're not giving dividends. So it's a 1.5 split that I have that is kind of like the structure I have with the investor. We're not paying dividends after the second year. There's no dividends until our exit horizon. So keep that in mind. Just because you see a downward trend with the cash flow does not mean the business is failing. In fact, that's what you want to see. That's the expected trajectory until the debts are paid off.
And very, very quickly, I just want to share with these guys how to actually analyze. Go up to the free cash flow section with the hockey stick. Yeah, so, okay, scroll down a little. All right, as you're able to see the EBITDA and the free cash flow, EBITDA is right above it. Scroll up a little. Yeah, as you're able to see, there's a major difference. EBITDA starting at 1.8, and we're seeing free cash flow at 1.1. Now, the difference between them, if you go to cash flow statements on the sheets, Nancy. No, on the other sheet, yeah. If you're able to see a cash flow statements, you could just double click at the top at the K. Yeah. So if you're able to see, EBITDA starts all the way at the top, and this is how you read a financial analysis. EBITDA starts at the top, then you got to count for, it goes from EBITDA to EBT to EBIT, EBT, then net income, right? And then the items that people forget after net income is net working capital, changes in net working capital. There's going to be usually investments, there's going to be repayments, it's going to be research and development, it's going to be a lot of items that don't get accounted. That's actually how you get your free cash flow. So you might be thinking you're at 1.8 million and the net income is 1.3. You could be like, hey, let's use net income, it's a little more stable. But then again, you're assuming they're not reinvesting. You're assuming there's no capex. You're assuming a lot of items, and you want to be careful with those assumptions because it will catch up to you.
And real quick, just when it comes to tax rate, right now, if you're looking at a business and the tax rate it's stated as at 30%, you may want to kind of see what's going on there.
It's like
Typically,
a placeholder tax rate.
Would not be 30%. It's and the tax rate is gonna tax rate depending on what it is kind of correlates with the entity. Right. So you want to be careful when you're looking at these tax rates. You're not going to see 30-40% tax rate on these businesses. If you do, that is an absolute red flag, and take that to your CFO or accountant to see exactly what's going on here. And if you do see that, probably their accountant, it may be an accounting error. rarely is it, but that accountant may not know what they're doing. So just be careful when you're looking at, the tax rate. It's rarely going to ever be 30% tax rate on business. That's just not common at all.
Yeah, and here our tax rate is not static, it's dynamic. You get your taxable income and divide it by your taxes, and that's how you get your tax rate. So if you see a static number on whatever finances you're getting from a seller, just double check to see, is it randomly placed or is it actually properly calculated? All right, Nancy, I think it's time to show the bonus document, which is the most
Yeah, so
important of them all.
this was the 10th document, right, that we use every day. Obviously, these we use every single day, right? But lastly is yeah.
Now, wait, wait,
So the
wait, wait,
bonus
wait,
doc-
wait, wait, wait. We got to set the stage. This is a document. It's not gonna be your cheapest. It's gonna be your most expensive document. But this is the document that's gonna close the deal. A lot of
yeah.
people have an LOI. LOIs are easy, but this is the document that actually seals the deal. This is the document that they're gonna take you to court with, and it better withstand that. So now you can bring it up, Nancy.
Yeah. I mean, there's one more document after this, but it has too much sensitive information I can't share there. But this is something that most people don't see. Most people don't make it to see this. So this is a draft. I'm not able to show the finalized asset purchase agreement because of the sensitive information that's on there. Now, this is an asset purchase agreement, and briefly, I'm just going to go over what everything that's in here, right? How extensive it is and why it's so expensive to have these documents. So when you're talking about, well, first of all, this is beyond the LOI stage. Once you're here, you're no longer dealing with the LOI. In fact, you're in your due diligence phase and you're coming up to that closing date, right? And obviously, it depends on what kind of timeline you're working with when you're executing that LOI. So with this here, I had 30 days to produce this document. So 30 days after the seller signed the LOI, we both executed. I had 30 days to come up with this document here. So when you're talking about closing a acquisition, there's a lot of things that's going to be in a very, very short timeline. And it's going to be very wild with respect to getting the deal done because it's just going to be so many moving parts. But this is one of the most important documents that you're going to have. Once you get to that closing stage, you're going to deal with. Now, the good thing is this is about a $10,000 document here. But once it's done the first time, you can actually use this as some sort of a template, and you can give it to your attorneys for them to kind of alter with respect to the deals that you're doing, right? But once you have that one purchase and sell agreement, you typically don't have to draft one up again unless you're talking about a stock agreement, which that's a completely different document. But this is a purchase and sell agreement, and this is how extensive this document is. And again, there's a lot of sensitive information here, even the draft. So I'm going to go a little bit quickly on here, but I just wanted to share with you guys what a asset purchase agreement look like and what everything that's in it. And I'll
Again, let
just
me
give
add
you
to it. This is not something you could just pull online. It has to be specifically tailored and drafted because it's going to reference various sections of the U.S. law, as you can see there, Section 4, Section 302, that are specific to certain items. Again, they could take you to court with this. These are legally binding documents. So you got to make sure they're properly done.
So, yeah, it has a lot of very small, minute things that defines them. But if you look here, business day, right? In our case, closed on Friday. Yeah. So the closings, I love setting on Fridays because the next day you're not doing anything. You have a little bit of time with your team to get all of your thought process together before you get into that day one. Day one is the first day of you being the new owner of operations, right? So, but it defines, these here are definitions, and it defines a lot of what you're dealing with. But this is so extensive. It breaks down every little thing, right? But like I said, I'm just gonna go, kind of speed through this. Obviously, this is very important that the financials that you have, it's in compliance with the GAAP method. So just going over this, like I said, guys, this is everything that's involved. If you have intellectual property and everything else, it's going to be in it. Liabilities. This lists absolutely everything. This is not the play around. This is not the play around phase here. This is where it's getting serious. You're spending a lot of money, and there are a lot of people who are, looking for this to close. So again, let me just keep going. so you can see the extensiveness of this document and everything that it involves. Like I said, I'm going quick because there's a lot of sensitive information that I'm seeing.
And see, I got a question. Are these documents a part of the course or are these separate?
Say that again.
Are these documents a part of the course or are they separate?
Yes, it's actually everything that we're showing here. If you guys, well, we have them individually, but everything is actually in the course. But your best bet is to get the course because within the course, I break down each document, what they're for, right? Instead of you just getting this separately and kind of winging it. Obviously, you could reach out to us for assistance, but in the course, it breaks down, what this is, why you would want to use that document, when to use it, when not to use it, or if you have a alternative document, why you should be considering that. So
And let
this
me
is
add to it
absolutely.
is it's gonna
Mhm.
be way more expensive if you're buying each document individually as opposed to getting the course and you get them all bundled up.
Yeah, absolutely, absolutely. But sometimes people don't need all of the documents that we have, so they may need one for that particular, for whatever reason. That's why we have them, individually. But this is another thing with the course. We also do provide one-on-one personal coaching. Like we actually hold your hand and we walk you through the entire process. So a lot of the information that we have, we give it out for free because we only know one person is going to take action. That's just the way the world works. That being said, it's one thing to have the information available to you, right? Information is basically free, but to actually know what you're doing, the proper steps, when to do it, when to execute, when to hold back, right? When you should execute with speed, and when you should kind of look at things in a broader view, right? In a longer timeline. That's what we do. So we do have personalized coaching one-on-one. And in fact, Valentino, should we drop the link for this course here or no?
Yeah,
I'm
we'll
not
drop it
sure.
in the comments. I want to make another point that is very important. Yeah, you guys are new, you guys are starting out, but then again, you're a leader. You're supposed to lead your team, not have your team lead you. And I think that's where a lot of people see the value in coaching instead of going back to her team asking very redundant or very
Yes,
amateur questions. You could just
yes.
come to us, get everything cleared out. So when you're speaking with your team, you're not asking but telling. And that totally makes a difference in your perception.
Yeah, absolutely. Absolutely. Again, perception is greater than reality, right? So it's great to have a team of advisors and people that you're counting on, but you have to be the leader at the end of the day. You have to be driving the vehicle.
Let me
They're
read this out
they're
very
more
quickly.
right, they're more of a navigator, right? Your team, they're more of a navigator to help you navigate the road, but at the end of the day, you're the one who's in the driver's seat. It's your vehicle, right? So just keep that in mind. But just real quick, reps and warranties is something that's covered here, but it is also covered in the letter of intent.
And the LOI.
And that's why I said our letter of intent is extremely, extremely, extensive. Because if you look at a lot of the things that are listed in this, in my LOI, those are some of the things that actually gets covered in this
Wait,
PSA.
very quickly, go back to your LOI because I saw a section that I haven't seen previously in one. Malpractice? Where's
Yes,
it
of
at?
course.
Malpractice liability. I don't think I've seen that in a LOI from the ones people showed me. Uh, but the definite PSA will define responsibility for malpractice liability claims. Again, like I said earlier, your LOI should be a reflection of your PSA. Your PSA should be an expansion of your LOI, not an addition. ANSI
Absolutely.
has malpractice liability mentioned there. So when they see that in the PSA and they see that more expanded upon, it's not something that's going to catch the seller off guard. Like, hey, we did not discuss this previously. But I want to make the a quick point section for 21 brokers. Scroll up for me very quickly.
Okay, here, yes, yes,
Yeah,
yes.
it says no broker, finder, or investment banker is entitled to any brokerage, finders, or other fee or commission in connection with the transactions contemplated by this agreement or any ancillary document. Now, this is very important because NC was stating to me earlier if there was a broker involved in an investment banker, they would take your fee, which is 5% of the deal. Can you expand on that, NC?
Yeah, no. I don't like dealing with brokers, obviously, right? And as a beginner, I don't think going a broker route is something that you should be favoring either. Now, it's a lot easier, right? The reason why people take the broker route is because you can easily just go to biz buy sell, and just pull up, I don't know, HVAC companies, right? Landscaping companies, construction companies. That's easy, right? They've done the work for you. But the thing is, they've done the work for you, but they will not allow you to negotiate the deal the best. Well, that's going to be a lot favorable to your team and the seller. As you guys know, brokers kill deals for whatever reason. They do not like to let them close, especially when you're talking about on a creative side, right? So I absolutely stay away from brokers, which is why I kind of showed you guys my fee agreement. And that's one of the ways that we get off market deals, aside from the cold calling and everything else, which is extremely ineffective, by the way, right? We have about 4 or 5 methods of getting off market deals. And again, approaching these investment banking firms, PE firms sometimes, and these M&A firms, that's one of the ways that we utilize. But we utilize this fee agreement so that way they know their fee, though it's secure. But that's the hard way, right? That's the hard way. And a lot of people, when they're starting out, they seek the easy route. But we stay away from the easy route and we do things that's hard because that's where the most rewards are hidden, right? Doing the things that are hard. So I absolutely stay away from brokers for a variety of reasons, right? But we have ways that we're able to get off market deals. I mean, very easily. You know what? There's a document that I didn't share. Guys, let me know. But we have a $5 million commitment letter from one of the banks that we use. So if you decide to, hey, I still would like to use the broker
Yeah,
and
we got the proof of
do deals
funds.
that's on market. Yes, the
$5 million
brokers,
dollar
they're
proof
the
of
number
funds.
one thing they're going to ask you for is that, hey, where's your proof of funds? And that's something that we have, and that's what helps you get, past these brokers, and they're a little bit more friendly with you, although they don't know how to value businesses, but, they become a little bit more friendly when they see you have the capability to perform, and that's having, cash that's backing you. You know what I mean?
And see, very
But
quickly. So we got a comment from a member. He says, "Love the content. I know you have the online course. However, do you offer any coaching?" Again, the online course is more for a beginner. You're starting to learn M&A. You want to study the information. Coaching suits you best if you're already in the trenches, already working on your deal, because there's just so much vastness of information. You might forget things. You want a second pair of eyes. So we will take on that consultancy role for you. Again, we'll be dropping the link soon. But the course, you're a beginner, you want to learn mergers and acquisition. Hey, it's all. Uh, I would say this is the most extensive course in mergers and acquisitions. It'll take you a while to get through it, but when you
in
learn
fact,
it,
I could probably,
yeah,
I
pull it
could
up, Ansi.
probably,
But when you
I could
learn it,
probably show the
you will
course,
be
right?
able to defend yourself. Again, a lot of people, a lot of the individuals in the industry like to simplify the process of mergers and acquisitions. I think that's very dumb because of the complexities of it. Instead, you want to understand it. You want to see yourself, and this is what I say, you want to see yourself as an architect. You want to be able to read blueprints. You don't got to know how to draft the blueprint. You don't got to know how to build the house. But if you're able to understand all the parts and components that go into it, you will be able to make it happen.
Yeah, absolutely. Great point. Again, I just wanted to scroll down to give you guys the entirety of this
Again,
document, what it
as
looks
we've
like.
been speaking, Ansi's been scrolling down this document, and as you see, it does not end. It's extensive.
So this is the law firm. Okay, so this is kind of the end of it, right? This was the seller here. Um, this is me, the buyer, right? And remember, keep in mind, this is a draft. The attorney put this here, new code, but it's actually MD Horizon Holdings. That's the entity that purchased this business. And then this was my attorney at the time. So this document cost me 10 grand, just this document alone. And you might say, well, 10 grand for this? Yes, because there's a lot of back and forth that happens in this document, right? Like, this is not something that the attorney drafts. It's a one and done. Absolutely not. This is going to take a lot of back and forth. I mean, we we had a escrow section here. We took it out because we did not do escrow. By the way, if a seller is asking you to put down money or make escrow, like a deposit, 50K, 100K, 200K, absolutely avoid that. That's not something that is typical when you're buying businesses. I don't want you guys to think that buying businesses is very similar to buying a house. That's not the way it is, right? So when you're buying businesses and you come across a seller who's asking you to put any kind of deposit down, it's because they don't trust your ability to perform. So this had that section in it, and I went to the seller. I'm like, this is not typical. We're not making a deposit. It was 50K they were asking for, and that got taken away. Okay, so again, this is a lot of legal jargon, guys, but this is what the entire document looks like, right? Buyer. Oh, so this was two companies we bought in one. So buyer, and I'm sorry, seller, both companies, and buyer. So that is the entirety of this document here. And again, it costs 10K just to draft this document alone, right? One thing I did want to touch on, Valentino, lastly, is the financials.
Yeah.
And let me just show you guys something here. Uh, Valentino, I actually want you to add this section on here. One thing that is missing from here is your fee, what you get paid. Um,
Good
I
point.
have I have a different financial projection that we use that my M&A director came up with. Again, me and Valentino did this. This is 99% Valentino, right? So we draft this up, but you're gonna have your investment banking fee that is into the closing fee. And your investment banking fee, well, the investment banking fee, it is the fee that you get for closing the deal. So a lot of people wonder, hey, how do I get paid? How do I get paid? Well, your payment actually comes from this. And there are two different ways that you get paid. If you are dealing with a investor, then you're going to get an investment banking fee, which is typically about 2.5%. But there are some other things that you can add on top of that 2.5% to make it go up to 5%, right? So if you're doing a $5 million deal, you can get up to 5% when you close, which is what goes in your pocket. And obviously, your attorney, the firm that you're using to close, you're gonna give them wiring instructions for whatever bank that you're using. That's typical. But I actually want to add a investment banking fee here, which is the fee that you get for doing the deal, right? For bringing the deal. But if you're talking about using 100%, well, not 100% bank, but if you're going to utilize maybe 80, 90%, bank financing, then the bank is going to actually give you a salary. So for one of the deals that I'm closing right now, the I believe it's 300,000. So 300,000 is what I have for my salary as the new owner and the new physician that I hire. So keep that in mind, guys. When you're looking at to know how you get paid, your payment is going to be in the closing fee. That fee goes there. Also, the fee of your team, how much your team is getting paid. It doesn't matter who you're paying. If you're paying one, two, three, four, five people, all of that is going to be in here, the closing costs, because you have to know how much the entire closing cost for the deal is, not just your professionals, but your team and yourself, what you're paying yourself. But typically, when you buy a business, the bank recommend that you take 75,000 is what the banks recommend that you take as a salary. But that's just the recommendation from the bank. You can go up to 100,000, 200,000, 300,000, depending on what your DSCR is. So the debt service coverage ratio, it depends on what that is, right? And if it's a very healthy number, I'm talking about 2.5, 3, 4, even a 5, then you're going to have a little bit more wiggle room, to give yourself an increase in salary. So just keep that in mind, guys. When you're talking about banks, when you're utilizing 100% banks, you get an investment banking fee. But if you're using investors, yeah, you get a fee, investment banking fee. But if you're utilizing bank financing, 90%, 80%, then you're going to get a salary that the bank recommend, but they're going to give you a parameter to stay in between. Like I said, the parameter we have is 300,000. And the banker was like, look, if we go beyond that 300,000, the DSCR starts to drop. But even then, right, you're still going to have a little bit more wiggle room. Now, that being said, you don't want to be greedy and say, okay, well, the bank said I have 300,000. Okay, so I might be able to hire someone for, 100,000 and keep 200,000. Don't do that because you want to know what the market rate for hiring a new person is, right? So once you know what that is, you can kind of say, okay, well, the market rate for this person to hire is 180,000, and okay, so I'm left with 120. Okay, so that's what it is, right? And that's the last thing I just wanted to touch on: how you guys get paid and exactly where that comes from and how you pay your team. It's going to be in the closing costs. of the deal entirely.
I got a
But that
few
being said, guys,
last wait. I got a few last points I want to make that are very important.
yeah, go
Um,
ahead.
First of all, with this financial model, don't be scared. All of this is dynamic for the most part. You're only filling in a few charts. All of
Absolutely.
this is automatically calculated. These are all formulas. If you go to financial analysis, yeah, the annual, do the annual,
Which one?
the one before that one, you're in the monthly. Yeah. So you would typically fill out this section. This is your P&L all the way till 2022. And then 2023 and beyond are forecasts. Those are nothing but forecasts. And then if you go to a monthly, same thing. You would just fill out your monthly. And it may take a little more time to do a monthly, but then again, you can see the irregularities when it comes to month. And then we got the forecast at the bottom. Uh, Now go down to the forecast section, the sheet. So this is automatically calculated. This is based on the numbers of the previous years. We calculate the yearly change, either positive or negative, and then we got the averages, which we then apply. 2019 is empty because for you to calculate 2020, you need to get 2019 and divide 2020, so 2020 and beyond. Go to cash flow statements very quickly. This is automatically calculated, so you don't got to do none of this. It's all automatically calculated. Now move on to the next section, the valuation. So this valuation is, okay, scroll in. This is going to be your DCF. For the most part, a lot of this is calculated. Now, whichever one you want to use is subjective. You got various ones. You could use terminal value or the discount rates. But you could go by the rule in finance is never offer more than what the enterprise value is. Because then you're definitely overpaying. You're paying for more than what is actually worth. And enterprise value is not the value of the business. It's the total value of all assets and liabilities. Equity
Do you
value
remember what the
is the
enterprise
actual
value is
value.
for the first deal? You remember the enterprise value? Remember the total was 6.3 million.
Yeah.
Okay, so it was 4.5 was the asking price, but with the seller finance and the interest and everything else, it
Yeah.
came up to 6.3. But do you know in 5 years what that what the
Oh
what
no,
the
that was gonna
enterprise
be
value is?
insane. Matter of fact,
I mean, well,
even let me circle back to a hyperbaric chamber. I think the enterprise value was in the 20 millions, 30
no,
millions.
I think the enterprise value was like 53 million.
Yeah, and you were offering 3. So I mean, we're the ones that make the big deals
Thought it was
and get the big
6.3.
returns. Yeah. So hey, enterprise value 50 million, we offered 3
Yeah,
million.
but remember that deal was not a norm, dude. Remember what my
Right.
M&A
That was a
director said.
literal
Remember
abnormality.
the returns
Move
was
on to the other section
astronomical.
because there's a section where nobody. Again, hey, add your favorite guru. I'll go one-on-one when it comes to his finance. Don't even play with me. But this is gonna be your deal structuring model, and then you're gonna be able to see how much you're gonna be paying for seller finance, the bank financing. Scroll all the way down, and there's gonna be a few more items that I included, which is going to be your earnout, your equity hold, investor financing, and equity injection. Above that, you got your return on invested capital, your free cash flow to firm multiple, and then you got your EBITDA multiple. And you might be wondering, why is the free cash flow multiple greater than EBITDA? And this is where people get it confused. A 4 times EBITDA in certain cases could be almost a 10x free cash flow to firm. The reason is the free cash flow to firm value is lower, so the multiple is going to be greater. And then go to the second section. Yeah. And there's your last section. There's the technical data. Now there's a real valuation. You're going to have to play with a few items like the growth rate, the discount rate, the risk-free rate. But for the most part, these are all automatically calculated.
Right, but when it comes to your assumptions, obviously you want to be extremely conservative.
Yeah. And do me a favor, you see there's like a little purple on almost all of the squares. Yeah. Hover over it. Okay. Now you're going to have to right click. No, the purple. Right click the purple. Yeah, the square. Wait, click it. And then right click it.
I don't know why it's not coming up.
Okay, well we fixed that, but
That's
basically
basically the notes you have,
I
right?
got comments for every
Right.
formula, how they're all calculated. Every single formula, it tells you how they're all calculated, which is good. Now, I want to make a few last points, and this is the most important one because everybody gets this confused and is the most basic thing in finance. Whenever you're valuing a business, whenever you're doing a purchase based on the earnings or cash flows of the business, and you're applying a multiple, the assets of the business are included in that multiple. Brokers, what they like to do is say, oh, based on a $300,000 EBITDA on a 3x, that's 900K. But then you see the asking price is like 1.5 million, and you're like, why? And it will say assets included. Do not fall for this. This is a trick. Essentially, they're trying to make you double pay. Let me break that down. If you own a construction company and say there's $2 million in assets, but the cash flow is only 300,000, well, say you apply a 3x multiple, the business is only worth 900,000. That's very basic, not truly how you value business, but for the purposes. So on that 900,000, they would like to include the $2 million, and now they make it 2.9 million. Well, let me ask you something. If you take away that construction equipment that company uses, how can you generate that $300,000? You cannot.
You can.
You can't. Essentially, they're double selling you. Same thing with a senior care home. You buy a senior care home based on the cash flows, the assets are included. What are the assets? Those are the beds, those are the wheelchairs, those are all the equipment. Because how can a business operate without its assets? It cannot. A business is its assets. Unless strictly these assets do not directly relate to the generation of cash flows, or you're doing a strict asset purchase, you never pay for the assets when doing a cash flow purchase. You actually bring up the course for me. Yeah, never do it.
What
And
do you want me to bring up?
yeah, the course.
Oh, okay, yeah, okay.
And lastly, SDE. Please understand this. SDE is for owner operators. If you're not going to be an owner operator, don't use SDE because the salary of the owner is included. They're going to assume you're going to take over a business. You're going to assume that salary. You're going to subtract that, and then you're going to see what the market value for that position is, and then add up the difference if it's overpaid, or subtract the difference if it's underpaid. So here you can see, of course, there's a curriculum. We got all these sections, and we're going to drop the link after the
Yeah,
live is
so
done. But walk us
so
through this.
with the course, right? I spent, I don't know, I spent a really long time putting this course together. So let me just go over it real quick, right? So the starting section is what you could expect from the course. Who am I? I talk about why you don't need any experience in 2023 to buy seven-figure businesses, right? And if someone tells you you need experience, that's absolutely a myth. But what you do need are certain things. One, you need leadership experience, or you need to know how to be a leader, right? And then how to maximize the use of this program. It's not for the faint of heart, which getting into business is, typically not. Why it's easier to buy a seven-figure business than it is to build one from scratch, right? The power of perception. Why a suit and tie isn't always necessary. I talk about that. Buying multiple businesses at once. How many can you actually buy, right? Then down here, the crash course. So this crash course here is something that we are actually going to update, right? So you'll have the latest crash course, and we're actually just thinking about making this something that is available to everyone for free. So that way you guys can just break into mergers and acquisitions instead of just having to get the course. But then I talk about the most important things and the most in-depth things that you need to know. So crafting an investment thesis. What is an investment thesis? Who's it for and who needs it? Building perception. Why does that matter so much? Right. So like right now, this video I have on a suit and tie. If I had on just basic t-shirt, perception would be slightly different. You know what I mean? So crafting your investment thesis, the best industries to create a acquisition platform, which a lot of people don't really talk about. How much industry growth is needed when you're looking at a industry? You know what I mean? So are you looking at an industry that's in previously has had 2-3% growth, or are you looking at an industry that's has 6, 7, 8% or more growth over the last 3 to 5 years? Interviewing industry experts, that is going to give you a lot of insights about your specific industry. And then we have low versus high multiple industries. For example, if you're talking about tech is a very high multiple industry. Another one is medical devices or medical technology. That is extremely high multiple. And then you have some very low multiple industries, kind of like smaller businesses. You know, if you're talking about mom and pops, a laundromat, a landscaping company, right? HVAC companies. And then if you're talking about just service-based businesses, typically have lower multiples versus the high ones. You have to be decisive when you're getting into mergers and acquisitions. It's not something that you can say, well, I'm thinking about, going in all the way, but I have some things that is just hindering me. Guys, this is the thing. Mergers and acquisitions, buying businesses, you're buying multi-million dollar businesses, right? So if you're buying multi-million dollar businesses and when you close the deal, you're gonna make 250,000, 300, 500,000 or more. That is something that's worth your time. It's not something that you're gonna make up excuses for. Say, hey, I work all day. I work 8 hours a day. I'm just tired, man. I'm just tired. I'm gonna pick it up tomorrow. I'm gonna do it tomorrow, the next day, the next day. Don't do that. You have to be extremely decisive about this is what you want, and this is something that you're gonna work hard on, and no excuses. You know what I mean? So I talk about that, and then we have your documents that you need to craft your investment thesis. How to recruit I'm sorry, yeah, how to recruit top tier M&A firms without giving up a lot of equity. So when you're talking about recruiting a team to help you and look at these deals and basically shore up some of the weaknesses that you have, that is something that you want to be careful about giving equity outright. So a lot of people waste a lot of time. I talk about how to stop wasting your time. What's a deal team, why you need one, how to build a solid team, all of these things that I talk about. So how to pick the best candidate, how to look for great industry expert, pros and cons. When you're talking about advisory board versus board of directors, just real quick, an advisory board does not, or they cannot change the trajectory of your company. They're just advisors. But if you're talking about a board of directors, these people are the people that have the power to, change the entire trajectory of the company, whether it's going left, right, up, or down. Board of directors have that power. So be careful of who you want to bring on. Do you want to have a advisory board or a board of directors? Equity distribution. Now you can say, hey, I'm going to give this guy 10%, 20%. That's great. It's on paper. But exactly when do you have any kind of vesting schedule? You know what I'm saying? Your compensation plan. How competitive is your compensation plan? Because there are headhunters out there, and these guys, their job is to actually take people, great people, away from your company and send them to another company. So you want to be careful about the equity distribution, how quick you distribute that equity out into who. Now, how to speed up the recruitment process using LinkedIn. Fast versus slow. In my opinion, you may want to go a little bit slower when you're looking for a team, if you're looking for a team that is going to be with you long term. Now, typically, you're not going to go through your entire investment horizon with the same team, but you want to make sure that you have people that's going to be with you as long as possible. Closing the deal team, and what's the next step? Keeping momentum. Do you really need a CEO and a COO to begin? And now, my opinion on that, differs. Depends on, are you using banks? Are you using investors? If you're using an investor, you're gonna need a CEO, but you're gonna need a startup CEO, not just any CEO, right? So how do you get LinkedIn Recruiter? That's basic, basic things here. How to use LinkedIn. Your executive summary, which you saw that version up there that we had previously. Cold calling, outreach, and all that stuff. Stop giving out equity like it's candy. What to look for in a good CEO. I mean, this course is so extensive, guys. Now let's go to the next section: obtaining legal counsel. Now, this is a 10K value itself, and just learning how to get these people to say yes, they want to work with you. Here's a trick, guys. When you reach out to M&A firms, I'm sorry, the legal firms, right, and the accounting firms to help you with due diligence, there's something specific you have to say. It's one phrase. For them to actually work with you on deferred fees, you have to ask them. So if you're talking to a law firm and they're going to say, hey, I'm going to send you the engagement letter. And then in your mind, you might already have told them, hey, we're looking for something that's a deferred fees, meaning we're going to pay you when we close the deal. They may agree to it, but they're going to send you their engagement letter and it's going to outline that you have to pay a fee. Pick up the phone and call the attorney, the partner, and say, hey, could you waive this retainer, the upfront fee? Can you waive it? By law, if you call and ask them, by law, they will waive it. But if you don't ask verbally, it's going to remain in that document. So that's just a little quick tip, guys, of how to just get these firms to work with you with zero fees upfront or zero retainer. You have to physically ask. The reason why these guys will do a deal with you, and even if it doesn't go through, if it falls through, it's not an issue for them. The reason why is because, guys, they write these things off. So no one's telling you this. So this is just free game. When you reach out to the law firm and accounting firm, ask to waive the fee when you're on the phone with them after you receive the engagement letter. Ask that. And then just know and say, hey, I know that, in the event that this deal doesn't close, you guys can write it off, right? But they're not going to tell you this. They're, of course not, right? They want you to pay. So just putting that out there. Corporate structure, right? I'm going to lean towards a holdings company, LLC, for this, but, ask your team and your attorney. And then we're talking about third-party professional accounting firm, how to avoid the big four firms. You don't need them. In fact, you need a more regional accounting firm. That's going to work. But make certain your accountant needs are met. There are a lot of things that you're going to need besides doing due diligence, right? So I talk about what those things are. What you need to know to avoid the BS. There's a lot of BS. There's a lot of noise on how to recruit, these third-party firms. But a lot of them is just bullshit. That's just what it is. Okay, so leverage your team's experience to meet accounting firms. That's very straightforward. Why use third-party accounting firms, right? And things that you would need. Again, guys, here's a hint. The things that you would need to outline is going to be a quality of earnings, but besides that, it's going to be tax and bookkeeping. Accounting firms explained big four versus national versus regional versus local. Again, stay away from the big four and the national firms when you're doing your first or second deal. You may want to look at a more regional and more local firm. And the thing is, regional firms, they usually have guys that are from big four. So very straightforward. Success fee versus in-house accounting due diligence. There's only one thing I actually outsource, and it's not the entire due diligence. So we handle due diligence in-house. Now, okay, let me just touch on, the deal flow. That is extremely important. I talked about how to, how we get some of the deal flows off market, right? But this is a lot, right? This is a lot, everything that's in this. And then section 6, analyze and valuations, right? So how do you properly value these deals so to make sure you're not overpaying for them? And then we have the negotiation 101, your price, my terms, or my price, your term, right? You have to set the tone when you're negotiating. And then we're going to come down to section 8, right? Strategies for driving competitive lender interest. So this here, I talk about how to get the best terms when you're talking about, dealing with your lenders and stuff like that. And then we talk about section 9, the efficiency. Well, basically capital raising. You know what I mean? So how do you raise capital? Do you need to? And then lastly, increase revenue in managing operations in your newly acquired company. So this is after you've closed the deal. What do you do? How do you manage it? Right. So again, I just wanted to give you guys a brief overview of what's included in this course and how extensive it is. We have the number one and most extensive M&A business buying course in the world. You will not come across another course about buying businesses that's more extensive than this course here, right? But with that being said, guys, I want to close out. Just wanted to share with you guys the documents that we use and where you can go to get these documents. And if you want them on a one-on-one basis, feel free to reach out to me. Valentino, let's close out.
And lastly, I know some of you guys love the Discord, want to be a part of the Discord. We're revamping that. A lot of the information is outdated, so we're doing in-house cleaning. You'll see a new Discord link coming soon with ready-to-go information. Again, if you're paying for the coaching, you're going to get access to that immediately with full access to all documents and information in it. But all right, thank you guys for watching, and you're going to catch us on the next video.